Hello, everyone. Welcome to PwC Tax Bite podcast series. My name is, of course, still Pieter, and I'm happy to introduce you to the second episode of a special series on CBAM and the broader European carbon taxation landscape. In the first episode, we talked about the CBAM developments, ETS developments, and we gave the broader picture and framework. And in this second episode, out of a number of episodes that will follow this one, we talk about the business impact of this development. So I'm very happy to still have in my virtual recording studio Helena and Aurélien, so carbon and trade tax experts, as I introduced them in the first episode. So the perfect persons to talk about and dive into the business impact. So welcome to the podcast, Helena and Aurélien. Um, let's kick it off with some details on the CBAM cost, because I imagine for the people in the audience of this podcast, this may be new and unclear what exactly the cost can be. So in the last episode, we closed on the common misconception, the idea that CBAM would only cost 2.5% in the first year. But Aurélien, can you take us a bit deeper into the details and explain how the CBAM cost is actually calculated?
Sure. So looking at the cost of CBAM, this is a formula that has essentially four building blocks. First, and this is one of the most important, you have the embedded emissions of the imported goods. So these are the tons of CO2 equivalent generated when producing 1 ton of that product. It's calculated according to the EU methodology and covers direct emissions from the production process. And for some sectors, for some goods, it includes also indirect emissions from the electricity consumed. But, and this is the key point here, importers don't pay for all of those embedded emissions. They pay only for the share that isn't covered by free allowances. Let me explain. So, as we briefly mentioned it in the first episode, EU producers under the EU emission trading system still receive a portion of their CO2 allowances for free. So free emissions under this scheme. And so to keep things fair between EU and non-EU producers, which is the whole point of CBAM, by the way, importers benefit from an equivalent reduction. And the level of free allowances is defined by what's called the CBAM benchmark, essentially a reference level of emissions that the EU considers free for a given product. So in practice, and this is where it's important, an importer will pay only for 100% of the emissions above the benchmark. And for the emissions that are below the benchmark, they will only pay a percentage, which is the CBAM factor. And in 2026, the CBAM factor is just 2.5%, meaning importers pay only 2.5% of the emissions sitting within the free allowance zone. And that percentage ramps up every year, reaching 100% by 2034. And mirroring the full phase out of the free allowances under the EU ETS. So to make this concrete, I'll try to take a real world example. So let's imagine you are importing 1 ton of hot rolled steel from China, CN code 7208. Okay, the default value applicable in 2026. So the embedded emissions of this good is a bit more than 3.5 tons of CO2 per ton of steel. Okay, while the CBAM benchmark, the reduction for that product is only 1.4 tons of CO2 per steel. And so here's how the math works. So the remaining, the deduction, so the 2.1 tons above the benchmark are fully payable, no discount. You pay the full carbon price on those emissions starting in 2026. And you pay an additional, so based on the CBAM benchmark, you pay 2.5% of the 1.4 tons below the benchmark. And so this is exactly why the kind of narrative that CBAM only costs 2.5% in 2026 is so misleading. Because in reality, the majority of the emissions on a high carbon import are payable from day one. So that was for the emissions part. Then we have the price of the CBAM certificate, which mirrors the weekly average price of EU ETS allowances. And so for the first quarter of 2026, as mentioned before, it's a bit more than 75 euro per ton of CO2. And so if we take that price and if we go back to our steel example, we are looking at a CBAM cost of around already 160 euro, so 160 per ton of steel, and as of 2026. Hopefully, there is a way to reduce that cost, and that's with the third building blocks, the carbon tax rebate. You can deduct eligible carbon prices already paid in the country of origin, in line with the recent Commission proposal we briefly discussed in episode 1. And so this reflects the core logic of CBAM, putting importers on equal footing with EU producers while avoiding double taxation because they might be already paying a carbon tax locally. And we expect this rebate mechanism to gain real traction in the coming years as more third countries like, Turkey or China develop or strengthen their own carbon pricing scheme. So definitely something to look into in the coming years. And then the fourth one, it's of course the volume imported. Everything I've just mentioned, described, it's to calculate the cost per ton of product. But your total CBAM bill is that per ton cost multiplied by the actual volumes you bring into the EU. And so for a company importing tens or hundreds of thousands of tons a year, even a modest per ton cost translates into a very material exposure at group level.
Hey, thanks, Aurélien. That was an interesting example. So, but also demonstrating that it's rather complex to do the correct calculation. In my view, starting from embedded carbon emissions and then the benchmark. So interesting. But the main message was clear, I think. So even with the free allowances, the cost is already very material from day one, and it's only going to raise. So that triggers an important question for me. With this kind of financial exposure on the table, who typically within organizations owns the topic or is responsible for the CBAM? Helena.
Yeah, that's indeed exactly where most companies are still struggling. And so CBAM, it is often initially landed on the desk of the customs or trade compliance team, because it is an obligation that arises when you're importing your goods. But in reality, CBAM cuts across the entire organization. So it's fundamentally a cross-functional governance challenge.
Okay, very interesting. Can you elaborate a bit more on what kind of functions are involved here?
Sure. So if we start with the procurement and the sourcing function, they are on the front line because they are sourcing the product. They are choosing where the CBAM product will come from and originate from. So they identify the CBAM covered goods. They usually help in mapping the exposed suppliers as well. We also see that they have a role in collecting the embedded emissions data because they have that close relationship with the suppliers. And you also see that in most companies, they are the ones who will start evaluating the lower carbon sourcing alternatives as well. Then you have still an important role for the customs and trade compliance team. They often still own the technical side of CBAM, the scope determination, the CN code classification, so the classification of the goods, the country of origin determination, They also manage the import flow, so they know when a CBAM product will be entering the market. And usually they are also still playing a role in the CBAM reporting. And often also they are the ones being looked at for the surrendering obligations. Then you have your finance and accounting department. They can play a role to forecast the CBAM cost exposure, assess the impact on the margins, the pricing, the model working capital. And then you have also an important role for tax. They own their own CBAM angle. You have the typical interaction between VAT and customs, but also think about new types of transactions that arise, like the buying of the CBAM certificates. What will be the VAT treatment of that transaction? Will it be exempt? Questions like that. Then you also have the direct tax treatment of the CBAM costs. Linked to that also the transfer pricing implications, because you see, the last time that we were calculating the cost of a client, it turned out to be potentially 10% EBIT. So there, the immediate question was, what will we do with that cost? Can we surcharge it to our clients, or should we absorb it somewhere in the organization, leading to that important question on what it will mean from a transfer pricing perspective as well. And then, what you also typically see as a last point here is the consequences of potential CBAM-led supply chain restructuring. If you decide to move a bit factories around, or other changes in your supply chain, or you do a direct movement of purchases to where the goods will end up eventually. So changes in your logistics flows. Also there's an important role for tax to make sure that the reporting is following those supply chain changes.
And then I would say also sustainability and ESG, they play a critical role as well. So defining the emissions methodology, the emissions calculation, especially for intra-group flows, I would say, and entering data governance, supporting suppliers engagement and decarbonization as well. And so on top of that, we've saw, I would say, support function like legal, IT and data, commercial and strategy, all with a real role to play from contract clauses to ERP integration to pricing decisions.
Okay, so thanks. That's effectively the entire organization that is involved. So I imagine that that's exactly how you would recommend companies to approach this, involve the entire organization and not just one function, right, Helena?
Yeah, indeed. So within PwC, we have developed our CBAM club with all the expertise combined. But that's actually what we also recommend clients to do. Companies build that internal CBAM work group, or CBAM club, how you want to call it. Make it a cross-functional business program, and refrain from looking at it as a standalone compliance exercise, because we see companies that treat CBAM as just another customs filing problem. They are going to underperform, both in terms of cost and in terms of strategic positioning. It really requires real coordination across functions, cooperation with your suppliers, a deep understanding of your product, the value chain, the supply chain, because CBAM, it follows the product movements, not the invoice.
Okay, now very clear. As you know, a lot of the audience here are people involved in the tax function of an organization. We talked about the need to have it cross-functional as a topic, CBAM. But beyond the compliance filings and so on, is CBAM also a topic which more strategically should be on the agenda of the head of tax, tax director, CFO maybe? What do you think, Helena?
Yeah, indeed. And there are a few reasons. So and they all hit the bottom line of a company. So first of all, CBAM, it's not a soft regulation. So non-compliance, it can lead to first significant penalties, and in the most serious cases, suspension of your import activity. So if you do not comply, you cannot import. So your CBAM product will not enter the European markets. Second, thinking about cost control and forecasting. So CBAM, it places for the first time a tangible price on the carbon embedded in a company's supply chain. So it's a price that is volatile and rising. We see it reshaping investment decisions, and we also see that it ripples across the entire value chain. So from raw materials to logistics and stakeholder reporting. So companies that model it proactively, they will gain a strategic edge. So, and those who don't, they will simply need to absorb the impact when the bill will land.
And also, let's not forget cash as well. Maybe sometimes a bit underestimated, I would say. So, CBAM costs are real cash expenditures. It's not just an accounting adjustment, right? You buy certificates, you surrender those certificates. The cash leaves the business. And CBAM hits above the line margins, it squeezes operating cash flow and tie up working capital. And so I believe this is exactly the kind of issue tax and treasury teams needs to actively manage. I would say especially as from next year when companies will need to start actually purchasing those CBAM certificates.
Okay, thanks, Aurélien. So if I hear you both well, what you're basically trying to underline is that CBAM is not just a customs filing, but has become a genuine financial management issue, right?
Exactly, Pieter. And CBAM, it's here to stay. It will also be expanded. More products will come into the CBAM scope. The cost is real, it's cash, and it is escalating. So, but there are also meaningful levers to optimize it. But only if companies treat it as a coordinated business program, you will really need that deep cooperation across functions with suppliers. A real understanding of the products and the value chains. We see companies that get this right away, they will protect their margins. And those that don't, they will see CBAM eat into a P&L year after year.
Yeah. No, very clear. Very, very useful, I think, also for the audience here. Okay, thank you. I think this was what we wanted to discuss on the topic of the impact of CBAM for the business. As I already explained, this is a sub-series on the CBAM, so we're going to have other episodes as well. One of the topics, and this is a bit my background then as an international tax transfer pricing expert kicking in, if I hear costs going up, my reflection is also, who ends up bearing that cost and that risk, and that has an impact, of course, for the people in the audience here on your transfer pricing, on your intercompany positions, and so on. So I thought, Helena, the next topic, and Aurélien, the next topic you wanted to talk about is CBAM in corporate strategy, pricing, and customers reflections. So is that right? Is that what you want to talk about in the next episode?
Yes, that's correct, Pieter. TP will wait a bit, but this is definitely also a topic that we will cover afterwards. Yes, we would like to further discuss the topic you just mentioned, because after understanding the cost and the governance challenge around CBAM, the next, I would say, logical question is, okay, what do you actually do with it commercially? Do you absorb the cost? Do you pass it on to your clients? Do you make it a separate line in item on your invoice, or do you embed it in your base price? So these choices send very different signals to your customers, but also to your competitors.
Yeah, and next to that, we will also explore how leading CBAM companies are turning this new regulation from a pure cost into a strategic differentiator. We see companies leveraging the lower carbon sourcing also as a commercial advantage, building a full customer narrative around decarbonization of their activities. And that's where compliance will meet commercial strategy.
All right, that looks very promising and interesting, I think, for everyone. So thank you very much, Aurélien and Helena, for this episode. That's wrap, I would say. So I would thank also the audience for tuning in and hope to see everyone again in our next episode, right? It's going to be an interesting one. Thank you.
Thanks, Pieter.
Thanks,
Bye.
Pieter.